Hi, this is JC Parets with AllStarCharts.com, and today we are looking at shares of Apple. They reported their earnings yesterday, and the market was not too happy about it. But the truth is, it really hasn't gone anywhere. We're still stuck in this range that we've been in for the last 5 months. So the first chart that we're taking a look at here is a weekly candlestick chart that goes back about a decade. And there were multiple reasons why $129 was our target in the fourth quarter and really coming into 2015. As you can see, we have parallel trend lines that broke in 2013 and quickly came back in 2014, to really reiterate how important these parallel trend lines are over the last decade. And we really wanted to be fading the upper end of that range. And sure enough, we got there in February, and we wanted nothing to do with it ever since. This also coincided with the 161.8% Fibonacci extension of the entire 2012 to 2013 decline. And as you can see, this is the level that we wanted to be fading. So now looking at it a little bit more short term, here's our target, about $129 that was hit in mid to late February, and we really wanted to be selling that level. And sure, did we go a little tiny bit higher and then fade? Of course. But in reality, we've really gone sideways, which really reiterates why it is that we pay so much attention to these Fibonacci extension targets. The market cares, so should we. So here's the correction in the fourth quarter that we were looking at coming into the year, and based on that correction, our target was 161.8% of that correction, which is a little bit over $129. Now, going back 5 months later, here we are in July, great, JC, the target was hit, but what do we do with it now? So here we are, here's the massive range. It's about a 12-point range that we've been in for 5 months, so I don't see any reason to get involved at this point until the prices prove that they can stay above the upper end of this range. So 1, 2, 3, 4 times that a level is tested. The way we look at it, the more times that a certain level gets bumped up against, the higher the likelihood that it's going to break. So with a rising 200-day moving average and the amount of times we bumped up against this level, I would argue that the higher likelihood here is that we break out to the upside. Now, that's just a total guess based on the weight of the evidence. We really have to wait for prices to break out before we can make those moves. So the 12-point range that we've been in, the measured move from there, would take us to $145. In addition, the 261.8% Fibonacci extension from that same correction that we were looking at in the fourth quarter is going to take us to 144 and change. So 144, 145, I think that's where we're headed, but we don't want to be buying this until prices prove they could stay above the upper range because the weekly time frame suggests caution.